Views on which markets are slated to outperform or underperform are as diverse as the range of indices that track them. Whether it's growth versus value, large versus small, or information technology versus the utility sector, there's no shortage of opinions on where alpha can be uncovered. Hello, I'm Ed Ware, and I lead the Wealth Management Channel team in the Americas here at S&P Dow Jones Indices. Joining me today for a closer look at how index data informs investors seeking to express investment views are S&P DJI's head of U.S. equities, Hamish Preston, and John Davi, CEO, CIO, and founder of Astoria Advisors. Gentlemen, thanks for being here today.
Thanks, Ed.
Thank you.
Hamish, to get us started today, can you please explain the difference between dispersion and capacity-adjusted dispersion?
Sure. So dispersion provides an initial assessment of the value of, or potential value of, correct insight. So formally, it's cross-sectional variation, but in plain English, greater dispersion means there's greater difference between the relative winners and losers in a given segment, whether that's stocks, sectors, or countries, for example. Now, I say potential value because, of course, when dispersion is higher, just as there may be greater value to correct insight, there's also greater punishment to getting things wrong. Now, what dispersion misses potentially is a real-world consideration, which is not only what's the potential value of correct insight, but also what's the potential scalability of the insights themselves. And so for that, we can turn to, say, the average constituent size in a segment. You know, in practice, it may be easier to take an active position in a $1 trillion company versus a smaller counterpart. And so that's where capacity-adjusted dispersion comes in. It combines the potential value of correct insight, so dispersion, with the average constituent size in a given segment to really marry those two elements. And that's particularly relevant because what we see historically is a trade-off between the average constituent size and dispersion. Typically, smaller segments show greater dispersion. And so that's the real benefit of marrying those two things.
Okay, so let's take this from a practical perspective. How, as an investor, from an investor's perspective, how would you use this information to make better informed investment decisions?
So I think one way that you could use that is to, say, normalize by what's the capacity-adjusted dispersion of insights into S&P 500 stocks, for example. And if you look over the last 15 years or so, you can do this assessment for S&P 500 sectors, S&P 500 style, indeed the US size segments, you know, expressing views across the S&P 500, the S&P mid-cap 400, and the S&P small-cap 600. And what the results show over the last 15 years or so is that expressing views and, of course, correct views and correct foresight in sectors or style, or indeed across the size spectrum in the US, could have been an order of magnitude more valuable than expressing views by picking, say, S&P 500 stocks. So that's just one example of how this type of insight could be valuable.
Thank you. So John, turning over to you, you've got over 20 years of experience across macro ETF strategy, quantitative research, portfolio construction. How do you use indices in your practice?
Well, I think you hit it like the nail on the head. We definitely feel like you've got to choose, sector size style to drive out performance as opposed to like very myopic stocks, right? So our investment discipline is, we combine kind of macro top-down research with quantitative analysis. The idea very simply is, okay, where in the market cycle, right? Are we late cycle, early cycle, mid cycle? And then pick the sector size style, which historically has done well, given that particular point in the economic cycle. And then we use, index products / ETFs in order to kind of express these views. So, I very much agree with a lot of what you had mentioned.
Okay, so as you're building portfolios for other advisors, what are the key considerations as you evaluate this ever-expanding solution set for your clients?
So I'll give you like a real-time example. We went into this year thinking that we were kind of in a new economic cycle. The Fed was going to, potentially cut rates. And typically when that happens, there's other sector size styles that do well relative to like the prior year. If you think about last year, it was mostly driven by the Mag 7 stocks. And, for a good portion this year, you had seen, equally weighted index products, do well versus market cap weighted. Now, very myopically in the last couple days, week, you've seen like some dramatic outperformance of market cap weighted indices versus equally weighted. But that's kind of what our firm would do. And then we use a lot of like portfolio construction tools in order to really decompose these ETFs. Whether it's, Bloomberg. I mean, there's some free tools online, Portfolio Visualizer, ETF.com. I mean, these are good because you've got to really unravel these ETFs to see what are your stock-specific risk, your macro factor risks that these ETFs are delivering.
And how much discipline does it take in your process these days? You talk about the Mag 7 stocks. How hard is that to stick to your, your process and look at that versus equal weight? How do you position there?
So we would say we would rather always be more diversified than less. So market cap weighted indices, we would do like currently at the moment now, given our view that there's a new economic cycle and the Fed is going to cut rates, we expect there to be a broadening out of the market and some leadership beyond the Mag 7. But very simply, like we would do like a third market cap weighted, a third equally weighted, and then a third like smart beta, which got a very bad name for many years. But we actually think now you want to be using some other quant ranking approach to weight stocks besides like market cap weighted, let's say.
Thank you, Hamish and John, for your insights today.
Of course. Thanks, Ed.
Thank you, Ed.
For more information on how market participants are using indices to inform their decisions and express investment views, visit us at the link below.